Good evening, everybody. I'm Dan Hussey with Zaner Hedge, bringing you our strategy of the week update here for October 5th, 2023. Remember, trading futures involves risk. It is not suitable for all investors, and everything we talk about here today is just my opinion, not a direct trade recommendation. Um, but if you're looking to get more involved with a broker or talk to anybody with a little more detail about the markets, we are always here over at Zaner to discuss that with you and turn these ideas into trading strategies for our clients. So, without further ado, let's hop in today. What the heck? Let's go with December corn. It's up on the charts here first. Let me get rid of that tooltip there. Just because it kind of gets in the way of everything we're looking at. Okay, so we're looking at the first overbought conditions here, really for the corn market here in the last couple weeks, right? We've come off of dare we call that September 19th low or 18th low? Was it there? Yeah, 19th low. Dare we call that the harvest low so far? But if the glove fits, we got a little bit of a cup and handle type of, or a little bit of a bull. You can kind of reversal here. We're up against, kind of similar to an inverted head and shoulders. The idea is that there's a threshold to break through now. That a short covering rally could extend towards. We've got that little bit of an open gap up on the charts around 521, 530 area. 50% short from that 572 down to the 468 low, 520 there with the 61.8 line at 533. You got the 55-day moving average that we're just breaking above today. Came in there at 492 and 3/4, breaking above that, closing above that for the first time. With a close above since July 27th. The 100 days just above us here at 511, the 200-day all the way at 541, and then you got that summertime high that the we wished we would have sold high, the first wish we would have sold high, the second wish we would have sold high here at 572, with of course that 630. I think that's kind of the, I don't want to say unobtainable top, but that is the top that I think it would take a lot to break through at this point. A whole lot. That $6 figure. I'm not saying we can't go there. In fact, I would love to get there. And there's strategies that we're talking about daily with our clients about how to capitalize on that. Right. Working whether that's working cash sales on the way up here, having those wish orders out there ready to go. We've talked with some clients that have, depending on your needs, right? And these are primarily hedge clients when I'm referring to clients right now that I'm talking about agricultural products, because that's who primarily we work with in that arena. But any of the markets, that we talk about today, crude, bonds, gold, the S&P, cattle, they're all there at your disposal, right, in the futures market to trade from a speculative standpoint as well. And we discuss the economics of each of those with our clients and with anyone that wants to listen. That's why you're here on this video today, right? But with all that being said, corn kind of finding a seasonal low now. The daily chart seems to have flipped. We've got a long trend maybe beginning and even an uptrend that has broken above downward sloping trend lines. That 18-day moving average that we flipped above here at the start of October, tested as support, now have stayed above, comes in below us at 482. On the smaller time frame, and so we're going to break down now the 4-hour chart for December corn. Take a look at the intraday price action. And those bigger levels, how they'll play out, in this smaller time frame. So that downward sloping trend line we finally have broken above has begun, a series, and from lows to highs here, you can see 50%, pullbacks, basically 2 steps forward, 1 step back. Beginning 2 steps forward, the next 1 step back. You could expect pullbacks perhaps from the 475 low to high. Today's low to the high after, well, I guess yesterday's talk about the Globex candle. 490 becomes a logical support area. We're going to get rid of this old other fib. The 490 becomes an illogical supportive area. It's the old highs here from the month of September. And look at how tight September was, 490 to 467. You go back in time here, we haven't had a month that is that tight in time. And on my charts, folks, these dark blue lines, these dark red lines, those are the highs for a month and a low. As you dial in here, the light blue and the purple magenta lines, those are the highs and lows for daily candles. We're looking at a 4-hour bar chart right now. So you can see multiple time frames on my chart, and I use that to identify, here as a level that, corn was struggling to break above at 490. You flash forward in time, boom, we bust above it. And I wouldn't be shocked to see, pull back in today's candle, hold above the 490 to 492 area support. To the extreme side, 487 can come down. We can justify 2 steps forward from that swing low to highs after, could constitute a new trend series, step in the market. So, 2 steps back could take you to 487 to 485. And let's not, discount or forget, or ignore some kind of channel that may be forming here with channel support all the way down to 482. And, that would leave, the last kind of big technical support, full 50% area around 483 from lows to highs. So getting a little too many lines on the chart, but the 2 levels that I personally like the most are they're at 490 to 491 and then 483 here, the full 50 back. I think that either one of those levels now on a pullback in the corn, got to think about being a buyer. That's if it gives it to us and we're not already in some kind of very sharp recovery. Tonight's session into the morning, we would expect to see that really pick up. So we'll see if that continues. Wheat was the other big market today that moved. And I think when we were looking at a reason why agricultural products moved today, particularly the row crops, the story with wheat and, the mining of a vessel heading towards the Ukraine. I don't know what the entire story was, but it was confirmed that a boat hit a mine. This is going to cause more of a scare for the insurance companies. Of course, Russia's probably going to come out and say a lot of lip service about how they weren't trying to attack anything and that the boat was in the wrong place. But nevertheless, I think it caused it caused the volume spike we saw at 10:30 a.m. when that rumor occurred. Let's put it that way. And that was the same push we saw, basically, that wheat catalyst to corn. I don't think soybeans got the love because it's not really a soybean story out of the Black Sea, but nevertheless. Downward sloping trend lines on the wheat, in Chicago wheat here, with the 18-day moving average basically being the exact same level. We're now kind of overbought in the daily RSI. So I'm very concerned that we have just basically dead cat bounced right up into, resistance. And if we don't, break through this level, I mean, we're kind of watching a trade potentially develop in real time here, because I think that this 480 area, I think there's a trade potentially to be had of trying to buy stop in above 482, right? You try to go with the momentum above this level for a potentially move back to the 55 of the 100-day moving average, right? And back up to this area in the chart, which I'm about to highlight with a rectangle, which was the old big major support there in May through June that we got a big bounce off. We got another bounce off of it there into July. Then we came down and broke through it. A move back up there to resistance, tested as resistance before we head lower would, not be out of the question for a down, trend. But in the near term, the trend certainly since August has been dictated by this 18-day moving average or this trend line. And that's where, boy, we break above that level here. I'm looking to buy it on the dips or even go with that momentum, I think, in my opinion, with, stops and risk, below either the lowest though here down around 538. That's like 40 cents. That's a lot of risk. So I think you can even just use lows of today around 558. And if we do make a move above this level, and you start to see the market go in your favor, stops go to lows of today, which is going to be up around 570, 573, wherever kind of, ends up being on, before it busts through, because you don't really want to risk anything, because if it comes back down into today's range below that trend line, a fake out head break, or a fake break, just run stops before coming down, right? That head fake, that can be very bearish very quickly. So if you are looking to go with the momentum breakout here on the wheat, which is a pretty, I think, widely publicized trend line or 18-day moving average breakout trade, be very vigilant with that stop. I think I'm a believer in this, but we'll see what happens, right? And again, upside targets, I think, could be considerably higher, 50 cents or so, all the way up there towards, 630. So if you can get away with risking 16 cents for the initial trade that trails a stop to break even, that has a target for 50, 60 cents higher, hey, that's a good, type of risk reward ratio with a defined stop and entry reason, rationale, and target all in one. That's a trade plan for you. And hopefully, right, there's fundamentals and a narrative to support that move beyond just a technical breakout at this point, because that's what will keep it sustained, is if there's a narrative shift. If we've become too bearish, if funds need to cover, those are all reasons we can continue to rally in wheat that don't rely on, exports and other, noise. But we shall see. In our other wheat contracts, to keep things kind of moving along here, KC wheat, similar downward sloping trend line, an 18-day moving average seems to be a little bit above us. So I think there's room on the wheat chart to find resistance, or new resistance. And I think that breakout on that Chicago chart will allow the KC to get back, up towards, its downward sloping trend line, and that I have drawn here up towards that 18-day moving average. But notice we're not overbought in that KC December contract either. Spring wheat is kind of the same situation as that KC. Took a bit heavier of a dive. I know that we're at a premium here, right, in spring wheat to the whole wheat complex. I get at times that, it's a spread game and you need to shave some off of, the top end, so to speak, to bring it down, because, well, let's face it, there's a dollar, almost 50 spread there between Chicago and spring. So Minneapolis spring wheat. So it's not shocking to me that maybe something's getting spread out, and bear spread to that regard. But I do think if wheat's going to bottom, right, you're going to see spring wheat favor the KC to favor a premium to that Chicago, as we still have it. So the first $1 to $10 will probably be the spring wheat, followed by the KC, followed by Chicago if they do that or want to do that. And there really isn't much to share on the smaller time frame charts for the wheat at this time anyway. It's just that, again, that's trend line. You can get really precise with it here on a smaller 4-hour chart and say, okay, you got to get above 580, but there's nothing to talk about here just yet until you're above that level, unfortunately. And I am afraid that if we roll right over, it could get messy pretty quickly. But that's fine. It just allows us to move on to other markets right now, and talk about one that is starting to really look constructive. Again, soybeans. Right? You're above $14, you're below $13. It's just the end of summer into fall. Oversold now in the daily RSI, finally comes out of its territory. The 18-day moving average is still above us at 1303 for the Novi beans. 3 waves back in equal legs into a 50% retracement here, which is at 1280. An double bottom at 1256 and 3/4 here. I mean, like, I literally can't tell you how beautiful of a technical bottom this could be if we break out. Now, the first real reversal is back above 13, in a real way. Day over day, we are almost there, folks. I think back above 1287 now at this point, above 1290, I'm starting to get convinced. Harvest low, I'm more eager to call and say that for corn. I think wheat can prove it to me here if it really wants to break above that trend line and make something of it. And I think if either one of those things were to happen, there's no way beans are staying down. Not when they're holding a, secondary bottom, right? Like their lowest lows are way back here. Corn chart came way out, corn came the equivalent on the beans of coming all the way back down to 11 bucks. Beans didn't do that. Beans held, that June low. Um, and now I think that beans, ultimately have an upside target. So let's take a look at, well, all the cluster volume for the moving average is still above us. That 100-day at 1307, 200-day at 1325, and interestingly enough, the 55-day all the way up to 1339. So I think back now above this 1280, 5 to 1290 area, which would be back above this old 1282 low, right? Um, and this low for that matter. Back into that region, I think opens the door to retaking those and going back to test for reversion to the mean. So I think we're watching that develop in real time, and um, I think there's ways to trade that accordingly. In fact, uh, let's look at one of those here in just a minute. But this 4-hour chart, look at this, equal legs down, 1435, right? You measure that whole leg down, extend it from the high here at 1409, 1257 and a half. I mean, beautiful reaction so far at that level. It's a 50% pullback here. This is a highly technical level that we're starting to break above. One, the first trend line resistance. Now the next kind of other one is up around 1320. That kind of aligns with this old support that was held sort of as resistance twice. It's 1320 to 1330. So I think that's the next level up. And wouldn't we know, or wouldn't you know it, that's up, around that cluster of moving averages, where the 100-day is at 1307, right? At 1323 for the 200-day. So that would just be a short covering reversion to the mean. You break above the highs this month. Let's go, beans. I'm a believer here, and I think that's that level at 1256 and 3/4. I'm worried if we go below it, it could get really hairy, but it's also very visible. I'm worried it could get hunted out before we go higher, but we're kind of making that move. Typically in these reversals, once we've started to do what we've just done, it's going to go higher or not right now. Looks that way for wheat, looks that way for beans. Corn, we're again, I think a little more confident in what I'm seeing on the chart, but in terms of that harvest low maybe having formed, but we're watching it closely here, right? Um, and an idea that I kind of was looking at here today, that was totally looking at. Um, in fact, I think the charts are already up here. Yeah, look, I already have the weekly option up. Perfect. So these go off at the end of next week. These are a soybean weekly option. It goes off the November contract, so it uses November as its underlying price, but it has a weekly expiration associated with it. I love weekly options where you can trade them. I think they are a fantastic vehicle, so long as you don't just hit market and chase these things. Like, look, for example, a 1280 call right now, there's a 3-cent spread right now at this time of day. You don't just hit the offer and buy that at 16 and 5/8. If you wanted to be long 1280 for the next week in the soybeans, that's a way of doing it with effectively whatever your cost is on that options. That's like having a stop down at 1264, if you want to think about it that way. But and you can't get stopped out, right? You have a whole week for the market to stay above that, because these do expire a week from today, technically on the Globex candle, but tomorrow on the calendar in 1 week. I was looking at the $13 call earlier today. It's gone up a little bit in value here. Not surprisingly enough, we were able to get these done for Oh no, I'm sorry, $13 call. We were able to get these done for around 6 cents, 7 cents, excuse me, which it looks like was about the market on them now. 7.5 offered, 6 1/8. It looks like they were getting done at 6 3/4 at some point here last. So $13. This is a call that goes off for the end of next week. It's 19 cents of the money, but for 6 cents, 7 cents, excuse me, it seems like you could own something that by the end of next week, um, you know, if we're right about where the market could go, 13.20 or higher, there's 20 cents of potential intrinsic value. Well, just based off of the 7 cent cost of this thing, it means you could maybe make almost 3 times, your investment of 7 cents in a call option that, expires in a week. So it doesn't have much time. But it also has very little risk in terms of the dollars out of pocket relative to trading the underlying, future. But it gives you and could give you almost as much bang for your buck if it goes to the upside, right? If you catch a rally and we're 60, 70, 80 cents in the money by next Friday, in the best case scenario you could dream, which has a very low probability of happening. But I mean, if there's a time where I think that soybeans could see a bigger move, could be down, unfortunately, too. But that's why you do something like this with, a 7 cent cost. I mean, 7.5 right now if you just go to market. But I got a hunch if you were to work an order, up from 6/8 all the way up to 7.5, you'd probably start getting filled somewhere around this last price, which is why it's the last price and why we look at that, right? I don't know for a fact, but hey, this is me as a broker, executing broker, looking at a weekly option that, that's a considerable spread between the bid and the offer of what it's going to cost you to buy that call. I look at this and use these tools to my advantage, right? I look at the open interest and the volume is to make sure it's relatively liquid. On an option that goes off next week in the agricultural products, this is decently liquid. It's tradable enough. And these spreads will tighten up by tomorrow. And as we get into a more liquid day session as well. Looking at the last price, understanding Black-Scholes modeling and how to, do finding those costs, that can all give you an advantage when looking at options and trading in futures in general. And now those are just, executional things to help you manage other costs, like accidentally paying an extra penny where you may not need to in a market. Those are things that matter. And I think anyone who's traded is familiar with the idea of slippage and where extra costs can come into play that you were not anticipating, right? Like, just from execution. So anyway, yeah, I kind of like that call in terms of a way of if we're wanting to look for something for the upside over the next week, that is certainly obtainable. And I think that, man, if it's right, it could be very right, and if it's wrong, it's only 7 cents out of pocket, 7 3/8. Somebody's listening to me. Look at that. Somebody lifting the offer on me. But no, I can understand that's going to keep happening if the trade is right, by the way, right? If the market's going to keep going up, that's the pattern you will continue to see in all these things, because that's just how call options operate. Something I think to be said here too is that if we have this double bottom, 1260, between 1260 and 1250, it's right at 1256, but the 1250 put makes a lot of sense for protecting the downside. Or if you want to buy something that's, if the market rolls over right now, will have a lot of bang for its buck to the downside. Because hey, we're traders here, right? I know many of us are marketing grain, right? Many of us aren't. Some of us are speculators. But at the end of the day, we're traders. We're here to make money, not be right. So that's why a call option gives you that opportunity, because it's not about being right, because you're not sticking your neck out and trying to force your will in the market here with holding futures and using a stop and moving that stop because it's, no, you're right and the market's wrong. That's not the way I like to operate, and I think anyone should operate. And it's tough not being that trader. I was that trader. I try to help people every day not be that trader. Because I'm a firm believer that of our sound mind, when we're developing a trade plan, there's a reason we did it that way, but then our involvement in the trade skews our opinion. And yes, there are some times in extraneous situations where it makes sense to do things, but often it makes sense to come up with a game plan where we don't need pitfall into that situation. So situations like this, you could stop in, below 1256, but again, using a put, the 1250 put, we go down here, I think we're going to go considerably lower. And in fact, every time but basically one that we came down to 1256, we pretty much stayed above it. But then when we go below it, boy, it really goes below it in a hurry. So if that were to happen again, that's why I want to own that put in some capacity too, which maybe that's the trade here today as well. Is like, hey, by the end of next week, bet on us going above $13 for 7 cents. And then also bet on us going below 1250. And you know what? If you wanted to spend 7 cents on either side, go with the 1260. But look, the 1250 puts for 4 cents by the end of next week. So I don't know. I just think these are interesting ways that, and two very attainable levels by the end of next week, could be very heavily in the money. Where we're in a market that has been in such low volatility that I think the volatility is starting to explode. And that can go on either direction. I think it's going to be up for a short covering rally in the grains right now, hence why I called and talked about the call first. But for all intents and purposes, flip a coin if we're going to talk about the probability of outcomes in the market being all things being equal. I think, oh no, I hope I didn't really lose connection. But no, the market will go and move, I think, considerably in either direction. And using options like this are, ways of being able to think about that or even trade that. For 10 cents, you can set up that trade. I don't necessarily like buying a put and a call. I think, I'm putting a strategy out there for anyone's bias. But the point is that if there's something to do, those are the things I would look at right now. And actually, it may be a situation where you kind of hold off and wait to see over the next day here into tomorrow of how we, other signals that trigger for your trade plan that say, hey, now I go for this way or that way. But anyway, try not to be biased and try to be objective myself, but it's hard to do because we are wired to have opinions. All right. Anyway, let's move on. I think it's worth noting here in the meats, the cattle, live cattle here. October live cattle, 180, 195, down into that 55-day moving average. The December fats, 185, again, into its 100-day moving average, or 55-day, 18-day moving average starting to roll over a little bit. This is a supportive area in the cattle. I think we'll see here in a sec when we look at the, November feeders. You're kind of below somewhat of a trend line, but definitely down into, your 100-day moving average now as well, and down into kind of this old area of confluence. There was a fight over trend here. Resistance, 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 resistance. Support held and we broke through, but it was resistance here from 1250 to 1255. We've come back down to test that area now of support. 200-day moving average way below us still. So if we don't hold like here and now in the cattle, I think that is a top for a while, and things could go down considerably. I see no reason to be super bearish cattle other than price needs a correction, because I still see, right, and I think the numbers still show, generally speaking, strong, beef demand, but the real kicker here is that the cattle aren't there for the time being. But if you think back to when this whole rally happened and began, 200 days back, in terms of cattle cycles, we've kind of run its course, in terms of being a 200-day long, solid run up or, into that area. And cattlemen wiser than myself can feed us all in the comment section about those cattle cycles and seasonality. And by all means, I encourage anyone to chime in, tell me how terribly wrong I am, but preferably, right, give us constructive criticism, but also your opinions of the market. If you're gonna comments on mine, give your own, and I love that. That's what we're here for, because I'll be the first person to tell you I certainly don't know everything, but I've got a lot of experience to share. So October live cattle 181.95 to the end of today, and that 55-day moving average also kind of back down into their cluster of maybe highs here, tested as support. You can drop a couple channels and what have you. we're into oversold now, right? On the daily RSI. So we've unwound any kind of oversold, overbought condition from a technical standpoint. Um, Not so sure you could say the same from, a commitment to trader standpoint, but um, I guess what I'm getting at is cattle could be at support now. This might be a buying opportunity in the near term. If you're short or you pick the top well, this might be a place to take a profit because how cattle bounce from this area, if they bounce at all, will be very important. If they roll back over and take out the low, I think that, take out the lows that wherever they bounce from, grand. If they don't bounce at all and we continue lower, I think that is another tell that we are just going to kind of really trend lower without much of a bounce. We've really reversed the top. So the question is the top in? Is this a topping formation? Or is this the best opportunity we've had, since the end of August to buy cattle? I don't know. You got to go, I think, with the first or the last of those, that this is an opportunity to buy cattle until it's not. Where would I put stops and manage risk on this type of trade? Well, I think that there's generally a short-term trend line here that we're kind of up against, which makes, you kind of basically say, okay, lows of yesterday become, very important, and that's really tight, so this needs to go here and now. It may do one more little capitulating push lower to plan for, but, I think you risk one standard deviation towards that 100-day moving average, a point or two on that thing before, and then again, you're looking for a move back to the 18-day. And again, if we had any lower, I think it's one you go with on the momentum lower. And you can always, I think wait for the checkbox of this feeder cattle market to take out today's and yesterday's highs perhaps before you come in and buy the fats as well. Okay, let's go on to some other fun stuff here. The dollar index, really strong move. It's still very much in a channel higher. There's a upward sloping trend line that aligns with that 18-day moving average. Here around 105.70, that not going to break below. Great, we'd come all the way back down. 103 to 103.90 to 102.90 would be the cluster of area to more or less look for support. But this has been a very impressive recovery. I was not anticipating the market getting back above that 200-day and that downward sloping trend line area. Well, of course, there was a game plan if it did, which is that we have to acknowledge the uptrend until it's not now. But that was the area, and the area that I even certainly advised and looked at taking shorts in the dollar that didn't work out, and that's why you use stops. And main reason being, right, is because, hey, if this was all head fake higher into a new range and we're falling back down into the old range that the dollar was in, which is from 102 to 90 way back when, right, okay, that's a big reversal. And I still think that could still be on the docket here, right? This could be two steps down, one step up, and we're finding into a 50% retracement from this high, right? Like, what's 50% from 115 down to 100? Well, guess what? Like 107, right? Like, boom, we're right there. So if the Dixie rolls over, it's a 50% short. I mean, this market is starting to trend lower, and if that's the case, we're targeting like 80 on this darn thing. And that's like like a monthly chart swing, but hey, and I'm not saying that's necessarily the case because let's face it, we've actually broken out of an old resistance, come back down to arguably tested as support, and now we're back above those levels. So I got to get back below 104, these old highs, for me to really feel more comfortable about that in the dollar index on the big chart. So that kind of gives us a little bit of a spectrum, and a look at another spectrum of the commodity, index, or rather the, I guess you could say, the inversion of the commodity index, right? Which is, if it's not, denominated, if it's not a, commodity, right, it is the dollar. So if the dollar is selling off, that helps our export markets. If the dollar is rallying, it hurts them because it buffers that and hinders that purchasing power of our trading partners, like China, to come and buy more soybeans or wheat or whatever it may be. So um, crude oil, big story of the week here. Whew, right? I mean, just whack, straight down. Well, couple little bounces there, but generally, right? I mean, kind of took the stairs up and the escalator, or the stairs up and the elevator down here, breaking our most aggressive kind of trend channel. Uh, um, After finding channel resistance from like kind of maybe larger channels of some structure here. And we're kind of down into that channel support now, and trendline support here against the lows in crude. It's funny. My partner Ted and he walked in the office today, and we kind of like looked at each other. Crude's down as much as it was, and is falling in about within an hour or two. We kind of were looking at each other, thinking, man, you almost just need to buy this thing down here now. Obviously that's not something you just throw a dart at, but the trader in us, obviously, we were getting the inclination to try to fade this pullback just because, hey, it's coming after a really nice prolonged, move higher in crude of almost the same magnitude and strength at times, right? Like, this sell-off is just about as strong as, some of these moves higher have been. Maybe a little wilder, but, some of those sell-offs are, and they can be, retraced just as quickly. So, big 50% retracement for crude, 63.60 up to 95. That comes in around the 79.50 area. So technical level we're pulling back, into in many ways. Stepping out to the daily chart for a hot second. We are looking at a continuous chart, but crude stays relatively tight between their calendar months. There isn't much changeover between the rolls, but technically speaking, these were prior month levels, but 81 to 82 is the level that we've broken out now on the November chart, right? And now we're kind of coming back to test it. It feels like crude has, broken out of some resistance levels, found, some old ones there again. But this is price discovery. Resistance, support, breaks through resistance, finds new resistance, finds old support now as resistance. I mean, it's it's how markets grow and expand in price. So if we see the market snap back, break back above this downward sloping trend line against the highs, take out yesterday's high up at 85. Those are all like, key reversal type signals. Those are, we're coming up off of levels now that I would be very interested in, maybe advocate and talk about being a buyer and, wanting to own a strike at like, up around 90 to 95 now, on a call, and sell something to 110 to 120 area. And you could go pretty far out, as a longer term positional trade that has finite risk and, a well-positioned call spread strategy. But we are down, maybe coming around the area that is support, so we could be looking to be buyers in crude here soon. We'll see. But I'm looking for that short-term confirmation. We just don't have it yet, and certainly, I'm worried we could still see a slide down into, another test of this old resistance, now support, and the 50% at 79.50. We've come all this way. If it goes there and then bounces, we'll have a much better story to tell, won't we? And that's, the nature of trading sometimes. It's like, the Schrodinger's cat paradox. We just don't know you know, um, we just don't know how well that cat is doing or not until you open the box, right? RBOB gasoline futures got absolutely whacked as well. But generally speaking, been just in a $3 to $2 range for the last year or so. The shorter time frame charts, or if you just look at, for example, just November. Um, Maybe December's better. No, I guess it's not what I was. I don't know what chart I was thinking of, but anyway, we broke below right any kind of upward sloping trend lines, but there has been no trend for a while. So the break in gasoline prices is probably the catalyst for the break in crude prices right now. Gasoline finds its bottom again here. Another signal to look for crude for a potential bottom. All right, and on to our financials to wrap up this evening. Let's start with gold and the precious metals. As I've talked about in prior videos, the rejection from 2100 again, big range in play. But the last leg up, maybe a 50% retracement here at 1852 to 1801. That's the kind of landing zone. You got an old low here around 1809, much like the soybeans coming down to a secondary low again into a 50% retracement. With an equal legs down, folks. That's right. So this first leg down, 2085, all the way down to 1900, extended up to and from the 2022 high. Equal legs is 1834. The 50% shorts off the highs here. They both went to their targets of 1857 and 86. So those 50% shorts, one of them is highlighted blue right now. And the other one's here. It was from that high to that high, or that high to that low. 50% there went to targets. Both of those set up into new, basically fibs. Basically, entry highs to target lows become a new Fibonacci pole in this instance. Actually, this more aggressive one that traded from 1975 to lows, that's going to be a low to low. So from 1914 to lows. That's where that one could pick up, and that's just because it blew out of its target and actually went to its secondary target. You can see there here down at 1848 or whatever it actually was. This bigger one actually just went to its standard target at 1856 here, not down to 1780 target. So we're just going to draw from that entry high from 2022 down to lows. So those are a couple of resistance levels on the way up to look for. 1870 and 1824. They kind of align with these other lows as well right now. And the 1870 is more of a continuation level. If it holds, that's the type of level that could really break the long and right away. But I think there might be support here. I'm looking for a move back towards 1870, above 1880 would then, chime me in for a reversal. And then, now we're talking about the 1852 swing that could take you up to 2200, and that would be a major breakout from gold. So is this the last pullback for bullion, before a major run up if we're in inflationary markets and all these good things? It could be the case, but if we're not, and we continue to break down below 1800, there's not much again until 1600. So is this a much bigger range and we're just coming back down? Got to see the reaction here. We haven't seen much of one yet. I think in the near term, on the daily chart, as you break down and you can see now 4-hour chart here, it's been so tight the last couple days. You really don't do anything with this chart until you start breaking above these prior highs and give yourself a reason and maybe even something smaller to pull back, buy a pullback on a dip. So you're catching a falling knife, even though I really like the bigger time frame. The only type of strategy I would put on or position I'd put on, unless I had enormously deep pockets, or unless you're going out and buying just raw bullion, which if you have any interest in, give me a call or give any of us over here at Zaner. We are a precious metals dealer and can get you metals straight out of our vault and vaults of our processing partners. But actually at fantastic rates. I only buy my bullion through my own through Zaner because of the pricing we have. It's awesome. And I mean, it helps too that I trust the company I work for, right? And hope you will too. But gold, call options and call spreads, right? When you're trying to pick a bottom, I think are more of an advantageous strategy for the futures trader to go with because you don't stick your neck out like you do with a long futures position, right? Where there's added risk of margin calls and even going debit. If we're going to think gold's bottoming, then you better think that the 30-year is going to try to bottom here. And I do think the 30-year is, due for a bounce and has hit some profit targets. So the next in the series, 145 highs to 117 lows, swing from 131 has went to its targets at 110. Next in the series now is drawn from that 134 high of the fire swing down to the new one, 122, and comes in right around where our downward sloping trend lines are. So against these highs, so again resistance from prior lows as well, 120 to 122 on any kind of bounce for the bonds, but bonds just trading lower, downward sloping trend lines channeling lower. I mean, it's been a very technical 50%. Stair stepping, two steps forward, one step back, 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 two steps forward. One step back would make 1, 2, 3, 4, 5, 6, 7, 8, 9. This would be the 10th time this market has traded in one step forward, two steps back. In this case, one step down, two steps down, one step up. Um, if that's not, systematic, coordinated selling, I don't know what is. It blows my mind, right? This is on the daily time frame, folks. This is not like, we're watching micro time frame charts and high frequency traders, right? This is like, um, it's just a beautiful bear market. I don't know how else to describe it. And at the end of the day, when you go back, a year or two in the past, this is, I don't know, I think it was very forecastable at times, but I also think that generally speaking, we've been on the other side, the right side of the inflation trade over the last couple of years here at Zaner, and it's been um, doesn't mean you are every day, but it's been an interesting couple of years, hasn't it? Right? I think we all have had to come to a realization of a new normal in some capacity. What that means for you, your trading plan, markets. Let's have a discussion at a later time. But anyway, downward sloping trend lines. We have a trend and a reason I think we could get a bounce. Um, it's just a market that has seen all the all the shorting opportunities that you could call out go to target, and now we're looking for a bounce. It's not necessarily a reason to buy it, but at least the bonds right now. But yeah, don't know what else to put it. I don't really trade that as much as we use it as a barometer for other things. The S&P 500, another beautiful three waves back into supportive areas. It's still in a bit of a downtrend, though. You can see two steps forward, one step back. Next in the series looks like it is actually holding potentially already, which would be from the swing from highs to lows here. That's where resistance at this high here at 4,300 is coming from downward towards 4,200 could be in the works. Taking a step back to the daily chart, you guys have all, I hopefully, seen some of my videos on the longer time frame for the S&P. If you haven't, I know it's pinned at the top of my Twitter, but I'll probably be doing an update of it sometime soon because generally speaking, I've done more videos since then, but one of those that pinned tweet, has to do with somewhere right around here, February. I talked about, if I forecasted where I saw the S&P going for the rest of this year, and it was basically just kind of a squiggly line going up into the kind of the right here, with the idea that okay, I was breaking out of this 4,200 area, right? Going up, we find resistance into 4,600. These old highs somewhere in there, and then there's going to be a pullback. And that squiggly line was just a reference to get everyone ready for if you're not already along the S&P, if you're not getting along the S&P for this run up, for crying out loud, please buy this dip on the S&P. I'm not saying today's the day. We could still have a little bit lower, 4,200, 4,100, but I truly believe that this is going to be one of the last big great buying opportunities in the stock market, in the equity indices, before another round of inflation comes in. And this will be financial inflation. This isn't going to be, because I think grocery store inflation's already happened. This is going to be the inflation that allows it to stick. People are going to start getting paid more. You're already seeing striking workers. Striking workers result in supply chain crunches, which I think from the pandemic, everybody becomes well aware means prices go up. Once these striking workers all get what they want, which is higher wages, that wage increase on the economy is always an inflationary move as well. So um, I don't see I could see how there's a lot of money still out there in the coffers of big banks. Let's just put it that way. And if the economy hasn't seized up already, I think generally speaking, things are still turning, right? Um, we're going to see over the next couple of weeks and how this drop in the S&P plays out, right? The best time to buy is when there's blood on the streets, as JP Morgan says, and when everybody else is at max fear, right? When everybody else is puking and wants to give it away, it's usually the time you go away and start picking up other people's trash. You know the term other people's trash is not one man's treasure? It's never more true than it is in the market. And understanding that principle and the behavioral science behind markets, I think is, again, why I've seen, and I forget who saw that. I saw somebody on Twitter saying just this, which was, if we see that Santa Claus rally and we're higher by the end of the year and into December, remember how you felt today and how nothing was different and blah, 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 right? Like, if that were to be the outcome from now until the end of the year, which who knows, maybe it's not, maybe we go to zero. But if that is the outcome, just remember these days where you are really bearish and everybody's like freaking out. Because this last couple of weeks, arguably, I've seen a lot of like almost hair on fire type panic, right? People are freaking out about bond markets going to lows, freaking out it's going to crash the stock market, freaking out the housing market's going to plummet, freaking out, that we're going into civil war because, we've got a geriatric president. We've got an ex-president on trial. We just kicked the Speaker of the House out. I mean, just like all of there's Russia's invaded the Ukraine. All of these just crazy things are going on, and there seems to be this palpable tension in the world, right? Well, yeah, maybe that's all right. Maybe I'm dead wrong, but uh, I don't know. I'm old enough now, and I've been through enough cycles. And by the way, I came of age in the Great Recession. So I like to think that these times of peak fear and peak madness are kind of where I got my understanding of the market, right? And can personally keep a level head. And that's, I think, over the last couple weeks, it's been a tough thing to do, certainly with hedgers. These are financial decisions we're making about our livelihood sometimes. Um, but it's been really hard, in the financial world where there's been a lot of, talk of fear and other things. Technically speaking, I think this looks like a beautiful buying opportunity back into support. We are breaking below, some trend lines, but I think that's all part of just the nature of the signal of the larger correction. I welcome a pullback to 4,000 in the S&P, and I think I would be a buyer in that opportunity. So watching, here, trading wise, I think just taking some smaller stabs here or there are not a bad thing. Don't fall in love with any positions right now, but, I like to point out to people that I think this is the big pullback. When it bottoms, which I don't know if really think it necessarily has just yet. It could have, there's a setup there. But there's a bigger level below us that, if we're following the same pattern that we witnessed in the past, and when I say witnessed in the past, I mean, going back to, the 1970s and before, where we have looked at, charts in the 80s and, the post-Black Monday run up in price in the S&P into the 90s. That's the type of price action that we're comparing this to. And I've done a lot of other work on it. Man, tonight it's been a lot of talk for a Thursday night, but I felt like there was a lot of kind of updating on the bigger picture stuff at this time. And there's a lot of, I think, charts that are developing right into some things that over this next week, there's a lot more of content and things to talk about. because we were coming out of periods, particularly for agricultural products like the row crops, that were very quiet or kind of, dull. It was too late to sell, but too early to buy for corn, wheat, and beans for a while here. And we'll see if into tomorrow that remains the case, but it seems like we're on the cusp of something happening and maybe a turn. Um, which hopefully we've covered all here tonight. So that being said, thanks for joining me. We'll be back with you tomorrow, I hope, with another insight, probably just taking a look at just kind of honing in on just a few places where things have developed. We'll be stay tuned into next week, of course, where we'll be picking up with some more of these, because the fall, coming out of the summer and into the fall, this is another stroke and another period in seasonality in the markets where I become very active, because this is when markets become active again. There's usually another seasonal push. I watch those trend and seasonal flows that we try to capture, and the summer was relatively quiet there, and towards it was a lot of protective trading, so to speak, into now into this fall period where hopefully we get some trend setting back up. I see some markets starting to brew. Let's see where price action takes us for the rest of it. If you ever want to get in touch with us or get any more information with what we have to do over here at Zaner, how I can help you out, how any member of our team can give something to do, 312-277-0110. That's my direct line. Give me a shout. Find me on Twitter. You all know me here on Facebook at dhussey@zaner.com if you want to drop me an email. Be sure to sign up in the information and comment section of this info. There's 2 links there. One of them, get this video for the strategy of the week in your inbox every week. A little mailing list there to have the email to you to check out at your convenience and not have to sift through the internet or go find it on some other web page. It'll be right there ready for you and ding you when I finally post it, right? Which can be at any time now, because trying to not do it as that webinar constrained just that period allows me some flexibility of finding out, maybe waiting for a reopen here in a night like tonight to see if we really gapped up above these trend lines and we're breaking out, because then that's a story I want to unfold for you. Unfortunately, we didn't. I was really hoping we would, because there'd be a lot more to talk about, but I think we filled an hour pretty well anyway. And check out, sign up for that daily call-in to hear from our chief market strategist, Hedge Seifried, where he drops a 5 to 10 minute bit for you to listen to at your convenience every day for where our heads are at Zaner, the newest news and hottest topics to keep you up to date, and of course some market strategy for where we think markets might be going over the next 24 hours. Have a great day, everybody. Have a better weekend in case you don't hear from me, and we will be back with you as price action develops. Take care, everyone.